Hey, Aaron Adams here with Infinity Investing. I know that getting a mortgage can be a really intimidating thing. And so I wanted to just give you a kind of a user guide of common terminology that's common in the mortgage industry and with loans and isn't going to be common with you. And so hopefully you can save this as a favorite and it can be something you can refer to before you go get that first loan on your first home going forward, because there's a whole kind of language that is used in the mortgage industry, and you need to know it so that you can really understand how to read any loan. And with this terminology, it really will help you demystify the sheets. Because if you go talk to a mortgage broker and you say, "Hey, I want to buy a house," then yeah, they're going to pull your credit and they're going to look at your income and they'll start putting together how much you qualify for. And a lot of times that can be like mystifying to people. What they're really doing is saying, "All right, I have 4 or 5 different loans that I work with all the time, and I'm trying to see which box one of these fits you in. Maybe if you don't make as much money, they're trying to see which one will qualify you for the most amount. Maybe if your credit's a little bit lower, they're looking for a loan that will fit that for you. Maybe if you don't have as much for a down payment." And so that's the thing you have to understand when you work with a loan person is, you have your loan person at the bank and they're just trying to do the loan for the bank. So they're going to be a lot less creative. The first kind of term that I want you to know is I want you to know what a mortgage broker is. And a mortgage broker is somebody that has access to multiple loans and they're just trying to match you up with one of those loans. If you go into Bank of America or Wells Fargo, they're going to want to put you in a very simple Wells Fargo. They have like maybe one box they can work with. But find a mortgage broker, and a simple Google search can help you find that, because they'll have access to more loans and they'll be able to more create, especially if you kind of know that you're close to qualifying, but maybe not quite ready yet. As far as you being ready, though, it's how much money you make, how much debt you have, and what your credit score is. Those are the biggest 3 factors. So are you currently working? That's going to matter a lot. And how much are you making? What are your debts? What do you have on credit cards? What do you have on car loans? What do you have on student loans? Because what they do when they do a loan is they say, what is this person paying a month for their bills? And is it higher than, if they get the mortgage on this house, is it going to put them over 43%? So what they say is, every month, if you make $10,000 a month, they don't want more than $4,300 to go towards your bills. So all of your car loans, your credit cards, your student loans, and this mortgage needs to be under 43%. That's the key ratio. Or in the case of you making 10 grand a month, needs to be under $4,300 a month. And so think about what your take-home pay is. Think about what you earn. 43% of that is about the most that you're going to qualify for. And what we've seen a lot is more and more Americans have huge amounts of student loan debt or really high car payments, and it's really eating up that 43%. You combine that with record appreciation, it's making hard for Americans to qualify with debt to income ratio and staying under that 43% umbrella. So that's something that you can kind of do the math on in your head. You're probably doing it right now, and think about that. Credit scores wise, you really need to be higher than 650. If you haven't pulled your credit, that's something a mortgage broker will happily do for you, is pull your credit, let you know what your score is. And so think about that combination of those things, because that terminology, they call it DTI. What's your DTI? Your debt to income ratio. And basically what they're wondering is this person under 43%? So what they'll do is they'll have you fill out a form and they'll have you, but you can do that right now. So what are your monthly payments that have to do with debt? So your utility bills don't count. What you spend on food and gas, it's your car payment, your student loan payment, your credit cards, if you already have a mortgage, okay, but then back that out. And then that space that's left over, let's say that those other bills put you at, 30% of your monthly, then the difference between 30 and 43% is how much you have for a mortgage. And so based on rates, annual percentage rates, they'll work backwards to figure that out for you. So DTI is a big thing. Now, with mortgages themselves, there are several different terminologies that you're going to want to understand. They'll refer to the APR, the annual percentage rate. I find that most people know what that is. Right now, they're between on a home that you're going to live in, 4%, maybe 5% is what people are paying. And this rate can be either fixed or adjustable. So I have a mortgage that I got on a piece of property. Let's see, that was back in 2006. So I've had it for 15 years. And I'm so glad that it's adjustable rate, because over the last 15 years, mortgage rates have just dropped. And if I would have been on a fixed rate, I would have been stuck paying probably 6%. And I think this last year it adjusted down to 2.3. So what happens is every December I get a letter from the lender saying, we've adjusted your rate to the current market rate. And for the last 15 years, every year that's gone down. That's less and less interest I've had to pay. Now, the risk was, what if over the last 15 years mortgage rates went up? Then I'd be much more frustrated that I didn't lock that rate in. So that's one of the things that you'll see on advertisements is mortgage brokers are always talking about, lock your rate now. You're never going to see this low ever again. And they could be right. And that might be a reason why you want to request only a fixed rate mortgage, so that you can get locked in for the next 30 years, which is typically how long mortgages pay off. Now, amortization is a little bit complicated, but basically amortization is the rate at which the loan gets paid off. And if you get a 30-year loan on your house and you look at month one and your payment's $1,000 a month, it will show $1,000 a month for the next 30 years. But what amortization shows is how much of that 1,000 is going to interest and how much of that is going to pay off the principal. And so what you'll see in an amortization schedule is early on, almost all of your payment is interest, and only a very small amount is principal. But by the time you get to year 30, almost 100% of that payment is principal and very little is interest. Now, it's really brilliant that our banks do this, because they know that very few of us go all 30 years and pay on the same loan. What do? We refinance. So what Americans do is they refinance. And what happens when you refinance? Well, a lot of Americans will refinance to pull money out of the home to get, they'll say, man, I only owe 100 on this house. It's worth 800. We could put a pool in. Let's refinance and put a $300,000 mortgage on this house and take $200,000 out, and we can do a pool and we can go on a vacation and buy a boat and all the crazy things Americans do with their home equity. But when they refinance, that amortization schedule goes back to zero. First month, almost all interest, very little principal. And banks love that you refinance, because the other thing they charge every time you refinance is closing costs. And you want to really ask your mortgage broker about closing costs. What am I paying? How much is it? Because that's where banks and that's where mortgage brokers and that's where lenders can really gouge consumers. So you want to be aware that, because what they'll do is they'll roll the closing costs into the loan. So maybe you got a $100,000 mortgage and you put 5% down, or $5,000, and you're wondering why your mortgage is $98,000, not $95,000. It's because of the closing costs. I'm like, oh yeah, we'll just roll that into the loan. Well, you're still paying for them. You just have a higher payoff amount on the loan. And sometimes people will have to, come in with cash to closing. Down payment, most of you are familiar with. You've heard about that. LTV is a term that might come up, loan to value. So what they'll say is, the lender won't loan any more than 70% loan to value. So if it's a $100,000 property, they won't loan more than $70,000. That's it. That's a phrase that can come up. Points is something that people mention. They'll say, you have to pay 1.5 points at closing. That's just percentage points. And so if you had a loan that wanted points up front, like they said, hey, you have to pay 3 points up front. It's a $100,000 loan. 3 points equals 3% equals $3,000. And so points and percentage are used pretty interchangeably. So hopefully that gives you kind of a start on this subject, and in less than 10 minutes gives you kind of a crash course on mortgages, on mortgage brokers, on terminology that you're going to come across. Get your credit score, figure out what your DTI is, how much below 43 is it, so that you know how much you can afford, or maybe you just need to stay renting for a while until you make more money. But it's pretty complicated, but it really isn't that complicated. And in 10 minutes, we hit a lot of the most difficult terminology. So it should demystify it for you. At Infinity Investing, we really value your financial education. If you haven't already been to our infinityinvesting.com website and joined our free basic membership, we want you to get started on that financial journey. learn how to invest in stocks, learn how to diversify your money, learn how to build your retirement, learn how to invest in real estate. Those are all the financial principles that we believe in and that we teach for free to everyone. And so take advantage of that, and hopefully we'll see you at one of our live events very soon.